Hey everyone, welcome back to the channel, and thank you so much for all of your incredible support. I truly appreciate every single one of you who takes the time to watch these updates, share them with friends and family, and stay informed about what's happening with Social Security and the economy. Today, we've got a mix of good news and not so good news for Social Security beneficiaries as we move deeper into 2026. And trust me, you're going to want to hear all of this because it directly impacts your monthly benefit, your Medicare costs, your taxes, and even what next year's cost of living adjustment could look like. Before we dive into the details, I want to quickly remind you about the link in the pinned comment. If you're interested in receiving up to $200 in free stock or even turning that into up to $200 in free cash, you can sign up through Robinhood using that link. All you have to do is open a free account and link your bank account. You don't even have to make a deposit. Once your account is set up, you'll receive a free stock worth up to $200. And if you'd rather have cash instead of the stock, you can simply sell it and transfer the proceeds back to your bank. It's a simple way to potentially put a little extra money in your pocket, especially at a time when every dollar counts. Now let's get into the real story. We are officially into the second month of 2026, and many Social Security recipients are still trying to make sense of how this year's changes are affecting their finances. Last October, the big announcement was the 2.8% cost of living adjustment, or COLA. On paper, a 2.8% increase sounds like good news. Any increase is better than no increase, especially for retirees and disabled beneficiaries who rely heavily on their monthly checks. But as many of you already know, the reality is a little more complicated. While the 2.8% COLA was higher than some early projections, many beneficiaries felt it still did not truly reflect the real-world inflation they've been experiencing at the grocery store, at the pharmacy, and when paying utility bills. If you're spending more on food, more on rent, more on insurance, and more on everyday essentials, a 2.8% boost may not feel like it's keeping up. And then came the not-so-good news. On November 14th, the Centers for Medicare and Medicaid Services, also known as Centers for Medicare and Medicaid Services, announced that the Medicare Part B premium would increase by 9.7%. Medicare Part B covers doctor visits and outpatient care, and for millions of Social Security beneficiaries, that premium is automatically deducted from their monthly benefit. Last year, many people were paying around $185 per month. With the increase, recipients are now seeing an additional $20.90 deducted from their Social Security check each month. Let's break down what that actually means in real numbers. Suppose you were receiving $2,000 per month in Social Security benefits before the COLA. A 2.8% increase would bump that up by $56 per month, bringing your benefit to $2,056. Sounds decent at first glance. But once you subtract the higher Medicare Part B premium, that $56 increase shrinks. Instead of keeping the full amount, your net gain might only be about $38 per month. That effectively reduces your real increase to closer to 1.9%. And when inflation is still running above 2%, that smaller net boost may not stretch as far as you hoped. This is why so many retirees felt frustrated. The headline said 2.8%, but after Medicare adjustments, the actual spending power increase felt much smaller. If you were hoping that extra $50 or $60 per month would give you breathing room, you may now be looking at closer to $30 or $40. And in today's economy, that difference matters. Groceries alone can eat up that amount with just a few price increases. Now let's shift to some genuinely good news. Especially for those of you currently working on your 2025 tax returns, there is a new tax break for Americans age 65 and older that could significantly reduce taxable income. Eligible taxpayers can receive an additional deduction of up to $6,000. That's not a credit. It's a deduction that reduces the amount of income the IRS considers taxable, and that can translate into paying less in taxes or even receiving a larger refund. On top of that, the standard deduction has also increased for 2026 filings. For single filers, the standard deduction rose from $15,150 to $16,100. For married couples filing jointly, it increased from $31,500 to $30,200. Head of household filers saw an increase from $23,625 to $24,150. And here's where it gets interesting. If you qualify for the extra $6,000 age-based deduction and you're single, you can add that on top of the standard deduction. If you're married and both spouses are 65 or older, that's potentially an additional $12,000 in deductions. So who qualifies? First, you must have turned 65 on or before December 31st, 2025. If you were already 65 or older by that date, you're in the running. Second, you must file as an individual, married filing jointly, surviving spouse, or head of household. Most retirees fall into one of these categories. You can claim the deduction whether or not you itemize your return. There are income limits, though. For individual filers, the deduction begins to phase out if your modified adjusted gross income exceeds $75,000 and disappears entirely at $175,000. For married couples filing jointly, the phase-out starts at $150,000 and ends at $250,000. The good news is that many retirees fall well below these thresholds, meaning they can likely claim the full additional deduction. For some of you, this could mean the difference between owing taxes and not owing taxes at all. Others may see a noticeably larger refund compared to last year. And with the increased standard deduction combined with the age-based boost, some retirees may find that less of their Social Security benefits are subject to federal income tax. Now let's talk about inflation and what's coming next. Another key development this month is the release of January's inflation report. The data comes from the Bureau of Labor Statistics and will give us a clearer picture of where prices are heading. According to projections highlighted by Investopedia, forecasters expect inflation to have decelerated in January, with core prices rising around 2.5% year over year. That would be the lowest level since 2021. If inflation is cooling, that could have major implications. It could ease pressure on the Federal Reserve to keep interest rates high. It could also influence what next year's COLA might look like. Remember, the COLA announced later this year in October 2026 will determine the increase for 2027 benefits. The formula is based on inflation data from the third quarter of 2026. So while January's report doesn't directly set the COLA, it gives us an early signal. In December, inflation was reported at 2.7% year over year. Earlier in 2025, it dipped as low as 2.3% in April before climbing back toward 3% in September. So the trend has been somewhat uneven. If January's number drops closer to 2.5% or even lower, that could suggest a more modest COLA for 2027. On the other hand, if inflation starts rising again toward 3% or higher, retirees might see a larger adjustment next year. The big question is whether inflation is truly under control or just temporarily cooling. Housing costs, healthcare expenses, and food prices all play a role in the CPI calculation. Even if the headline number looks tame, individual households may still feel pressure in specific spending categories. And for retirees living on fixed incomes, even small changes in inflation can have outsized impacts. So here's where we stand. The 2.8% COLA sounded promising, but was partially offset by a sharp increase in Medicare Part B premiums, effectively reducing the real gain to closer to 1.9% for many beneficiaries. On the positive side, there's a meaningful new tax deduction for Americans 65 and older that could reduce tax bills and increase refunds. And finally, we're watching inflation data closely because it will shape not only the broader economy, but also the future of Social Security adjustments. As always, I want to hear from you. Are you feeling the impact of the Medicare premium increase? Has the new tax deduction made a noticeable difference for you? And what do you think inflation will do in the coming months? Drop your thoughts and experiences in the comments below. These conversations help everyone stay informed and prepared. Thank you again for your continued support. If you found this update helpful, make sure you give the video a like, share it with someone who needs this information, and don't forget to subscribe so you never miss an important Social Security update. I'll see you in the next video.